Hey everyone, welcome back to another stock market open live stream. Well, it is 5 minutes from another data set, and apologize I wasn't able to stream yesterday. You kind of just got the video of me in this room, but today we've got some additional time, so we will do a little bit of a stream. Starting with data now out in 4 minutes. We're going to start with personal income, personal spending, real personal spending, which is inflation adjusted via the same PCE report. PCE month over month, PCE year over year, and then core month over month and year over year as well. All right, so we will begin that coverage, and we're going to be looking at retail inventories, wholesale inventories, so a couple of extra things as well. Then at 7 a.m. we get University of Michigan sentiment. That's it's the final read for September, so it's really just the second stab at something we've already seen. So it really shouldn't be a big deal. So I don't think that one's going to be much of a catalyst. But this morning, in terms of getting personal income, personal spending in, and then the PCE numbers, PCE usually doesn't come in with any kind of shocker of a number. And that's usually because it's based on components that are within CPI and PPI. And so Waller from the Fed, remember, he told us, hey, we basically already calculated PCE, and we think we're at that 0.1 range on a month over month basis. 0.18. I want to say it was core, and then super core at basically 1.8% annualized for core, and then 1% for a super core. So we should see some pretty low numbers here, and we'll know in just a moment. So that data will be out in 2 minutes. Yesterday we did have an entertaining day. You had a lot of enthusiasm in the morning. It did seem like right around the time Supermicro got hit with its DOJ probe, a lot of things sold off, which is weird because usually an idiosyncratic hit, so a one company hit, doesn't become systemic unless you have lower liquidity in a market or you're in a higher volatility market. I think that's probably exactly what we're in now. It's a lower liquidity, higher volatility market. And so a little bit of bad news can create reverberations throughout a larger market sector. So I think that's what we're seeing now. We'll see. It looks like, Duo. Duo. What Duo? Why is Duo Fanged Network, whatever that is? It's like rallying like crazy this morning. Let's see what that thing is. Hold on. Duo. That's not Duolingo, is it? No, Fang. Yeah, because Duolingo is Duo L. Duo, just Duo. What is this? That is Fanged Network Group provides real estate services. The company offers buying and selling and renting houses in China. Oh, wow. Okay. I don't even know why that's here, but that's interesting. So yeah, after the Chinese stimulus, that has really started taking off. People probably don't really know about it though. That's crazy. Oh my gosh. Okay. So interesting. Okay. Anyway, data in about 23 seconds. Neo on fire, says someone. Let's see here. Let's see, Neo. Yeah, I mean, China's getting the stimulus fire hose, huh? 2.3% yesterday, 4% this morning. Seems like an entertaining morning that we're going to have. So let's see what we get. Economic data will be out in about 20 seconds. So I'm looking forward to that. And we'll get that covered. All right, here we go. All right. So let's see here. Personal income and PC. Here we go. And wholesale inventories match expectations. Personal income comes in lower than expected. Personal spending comes in lower than expected, both at 0.2, which puts it minus 0.2 for personal income, minus 0.1 for personal spending. Not great. That's, again, sign of the deterioration of the consumer. Still waiting for the PCE data. And month over month comes in at 0.1. Month over month core comes in a 0.1 lower than expected. That's good. Real spending comes in at a match of 0.1. And again, so far, the only bad news here is just a weaker consumer, again, with personal income coming in minus a 20, to 0.2, basically, so 20 basis points. And the year-over-year price index just came in at a zero point 0.1 lower than expected. So PCE, as Waller predicted, did come in softer than expected. Inventories came in at expectations, and personal income and spending came down. So this is really a report here that says, look, less inflation, Fed cut more, which is actually honestly just bullish across the board generally. It just, you need the Fed to act quickly, though, in order to avert a recession. So, if they don't act quickly enough within, I personally think the next 3 months here, well, then I think you're probably knocking on the door of recession. But yeah, I mean, it is convincing the markets that there isn't going to be a second wave of inflation isn't exactly the easiest thing to do. I'm relatively convinced myself that there isn't going to be a second wave of inflation, but markets appear to be cheering this. Let's jump on over to Zeviba. There we go, Zeviba. So here you can see the Qs. Qs were up 75 bips yesterday. We got a little bit of a spike up over here. We were already positive. We just got a little bit more positive. Same thing over here at Tesla. We were positive, got a little bit more positive on the data. NEO, not much movement on this particular release, but that's not a surprise. You got, because it's U.S. economic data. IWM back to about 220 on this one. What's interesting here is if we zoom out on the day chart, oops, not used to this tiny setup. There we go. If you zoom out on the day chart, you're basically getting to where you were at the previous highs. So you could see previously we got rejected here at 235, and we really got stuck around 223, 224. See that here where my mouse is? 3 rejections there at that 224 level. Boom, boom, boom. We're actually still technically below that level now. You can see we almost rejected again at that 224 there, and then had a failed breakout. Oh yeah, and then yesterday it rejected at that level again. Honestly, I mean, that's good enough of a line for me to, I'll probably go ahead and put a white line there right away. I'm going to skip the trash line. Let's start with white. Here we go. So let's drop one right there. Look at that. How does that look? That's a good looking line. And it even worked over here too. So that's a nice line. All right, I'm going to lock that into place. There we go. So, okay. Does that look, that doesn't look white though. I'll make this white. Boom. There we go. That's much better. Okay, good. So, okay, very good. Then this is IWM. Interesting. You're getting a little bit of a sell down right now on some of that initial optimism on Tesla, as well as the Qs. There it is. Loads in after a second. It's a little strange. Okay, so we'll keep an eye on this. Rocket Mortgage moving on this. You've got the triple leverage 20-year bond fund. Seems like it's moved on this, which makes sense because, again, there's so much of this fear that there's going to be the second wave of inflation. I'm personally not worried about a second wave of inflation. I'm worried about the Federal Reserve moving too slowly and sending us into a recession. That makes me the most nervous right now. And the way the market is behaving is one that is very reminiscent for me of November of 2021. And then also when you look at the chart statistically of the 6 weeks after the Fed's 50 basis point cut in 2007, is Kevin still short? I'm not short the market. Like, it's funny. I think I have to say that every day. Like, just because you're a bear doesn't mean you're short. You know, you could just not be playing the game. Anyway, so Bitcoin seems to understand the logic correctly here that this is broadly good news. Again, as long as the Federal Reserve actually gets off their behind and gets to work, I think that's very, very, very important here. So let's see, what else do we have here? Yeah, it doesn't surprise me that Amazon's moving down on this consumer move here. Not bad. Then you were short, my friend. Dude, Mark, I haven't been short the market for since August, early August for a week, and a little bit at the end of July. Relax. So like you go short 1 week out of the year, and then whoa, you were short. Chill. Like, it's illogical. Get some logic in there. I can see the headline now. Second wave of inflation is coming. Commodity Steve was right. Well, there was a period of time where inflation started ticking up again at the beginning of this year, and people were like, "Oh my gosh, this is going to last," and it didn't. Hopefully, it doesn't last, because I think it would be very, very bad. What about all the inflation or stimulus in China? Will that ignite inflation? The problem is China is in such a Kevin, you got to relax. No, Kevin doesn't relax. Kevin never relaxes. As far as what was I going to say? Gosh, what I was just going to answer a question. I forgot what it was. Titanic video request. That would be funny. Put all the recessionary items in there. That would be funny. But anyway, second wave's coming. No. Okay. Oh, the Chinese stimulus on inflation. That's what it was. Thank you. Okay. So Chinese stimulus. No, China is so deep in a depression that the stimulus that they're providing is very, very low relative to what they need out there. I think they are in a position where they are supporting China as much as they can to try to change the sentiment of what's happening in China, but I don't know if it's going to last. And so that does make me a bit concerned that no, China's stimulus isn't going to create inflation. I just wonder, will it be enough? Will they actually do enough to turn around a deflationary crisis? Usually, once you're in deflation, the answer to that is no. What happens is people take their stimulus wealth, after the Chinese stock market rebounds or whatever, and at the first sight of the market going down, people just take profits again, and they use those profits to go pay off debt or whatever, and really just prepare to stick it out longer. So I don't know. I'm not so optimistic China, but the problem with that is I don't know China as well, right? So my thesis doesn't necessarily have to play out. That's just based on the research that I've been doing. That I feel like it's risky. Somebody here says, we've been in a recession since last year. I own my business and customers can't afford anything. Yeah, well, I mean, it is a fact that one of the problems is you get a lot of consumers that have substantially less wealth because they've spent it. I mean, look at the personal savings rate. It's just gone to trash, and that is in part due to people having earned a lot of money during the pandemic or gained a lot of wealth during the pandemic, but slowly having started going through that. But anyway, I'm just looking at these personal income and personal spending numbers. Really, honestly, both of those coming in lower is bad. Personal income coming in at 0.2 and personal spending coming in at 0.1, 0.2, which was 0.1 lower than expected. It's not great. It really it was lower than the expectations, and it does show you that the Fed's tightening is really starting to bite. And so it would be very, very nice for the Federal Reserve to actually get off their behind and start cutting a little bit more rapidly. That's how you could really avoid a recession, I think. Let's get another 50, maybe even go for larger. That's where my world is. But anyway. So, okay. Oh, I wonder what yields are doing. Let's see the yield market here. So let's take a look at the curve. Okay. So futures are obviously green. The 10-year is down 2.5 basis points, which is fine. And then the 2-year is down 2.9 basis points. So that would be a reiteration of the slight steepening of the yield curve. So if I go to, let's see here. Yeah, but yesterday the yield curve actually came down a bit. Oh, that's interesting. Yesterday we went back towards inversion a little bit, and then this morning up a little. So we're at about 17 right now. Remember, my take of the danger zone is that 50 to 90 zone. That's a recessionary zone. Okay. All right. Very well. Let's see what some other news is that's going on here. Okay, dokie, 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 dokie. So this is Bitcoin. This is Tesla going up to the 258 over here. And the Qs are climbing up, which is nice as well. Okay, so... Okay, let's see what else we have here. Fed's favorite inflation game, consumer spending barely right. Okay, let me read this. Fed should stop tying its hands on interest rates. Okay, let's see what you got. So far, so good. The Fed's effort to engineer a soft landing are going well. Last week's 50 basis point cut in the central bank's policy looked right. What matters now is the Fed should stay open-minded about future policy. That's a challenge because of the way the Fed explains itself. Investors rightly saw a small change in rates as not that significant in itself. More important was the implicit message about the central bank's intentions, right? The pivot. Interpretation, though, makes the Fed's job harder. A rate reduction might have happened earlier had the central bank not feared committing itself too soon. Powell understands the problem. He takes care in his statements in the news conference to emphasize the data dependence, blah, blah, blah. This is... Are they going to get to any kind of point over here? Not really. Kind of just like, all right, well, let's see. You have data dependence or firm forward guidance, but not both. Oh, okay. He's sort of towing the line of both is what they're saying. I get it. Yeah. What's interesting to me is I think this the rally that we've seen is well, I mean, just based on data too. You can look at it. The markets are pricing in today about an 88% chance of a soft landing. So you have an 88% chance of a soft landing priced into the market, which seems a bit euphoric to me. I'm not the biggest fan of this market at this point, mostly because of that risk. This risk that the stock market is basically in its latest rally here removing its downside protection. And data continues to indicate that the consumer is rolling over, and that sooner or later you're going to have that jobs rollover. So again, hopefully the Fed goes faster because I'd prefer that the entire country be able to avoid a recession. I think recessions are really bad. I know a lot of people look forward to a recession because they're like, oh, I'll be able to buy things cheaper, but it's like impossible to get a loan or to actually have a job to be able to afford things in a recession. It's quite challenging. Okay, let's see here. Let's see what if Nick T has said anything. Okay, let's tab over. Okay. Let's go to... I want to get Nick T. Nick Diermos. Okay, nope, 15 hours ago. No message from Nick D. Darn it. Are you sleeping in today, Nick? What is this? Okay, fine then. Let's go see if I can get some other messages out there. Let's see, just try to get some initial reaction from some folks on the data. Good news on inflation, but bad news again on the consumer. Okay, what else here? More Van Gogh oil losers damaging a Van Gogh painting. Okay. I just think that's ridiculous. Okay, we saw the data. No, there's not much. Wow. Yeah, that's interesting. Okay, fine. Let's go into, let's see here. Let's try the journal. Let's see. Well, is Nick going to be Chinese indices post a best week in years? Let me see what the Hang Seng did yesterday. Oh, 3.5%. I mean, that's pretty good. So that means we are now year to date up 22.9% in the Hong Kong Stock Exchange, in their largest index. Of that, 20% was frankly within the last 2 weeks. That's insane. So of the 22%, the HSI has returned. 20% of it happened within the last 2 weeks. That's crazy. Okay, that's interesting. If the dock worker strike causes a slowdown in supply, would it push inflation back up or push us into recession? There are a lot of people wondering if a lot of pre-ordering was done sort of in anticipation of the worker strike. So I don't know. That's actually a really good question. I suppose it depends, because shipping rates will go up. When shipping rates go up, that can drive an increase in cost. But it can only see where are you? I'm in a lobby. Okay, there's an elevator. The problem with assuming that the dock worker strike would cause inflation, which I think is wrong, is that it assumes that companies can pass on the price increases. And I think that the answer to that is they cannot. And so when companies cannot pass on an additional price hike, then what you're going to do is you're just going to hurt company margins. You're not actually going to benefit, you know, well, I mean, you're not going to, I shouldn't say benefit, you don't benefit anyone. You're not going to hurt the consumer with higher prices, just increase the problems that companies will face and the layoffs that they might cause. Yeah, that's the challenge. Democrats won't allow the strike until after the election. I don't know about that. I haven't had any coffee yet today. Somebody's asking. Ellis, that's awesome. Listened to Kevin during 22, bought and held through the V-shaped recovery, taken profits along the way of my down payment for my first house, also at portfolio highs. Congratulations. That's awesome. Talk about TMF. So TMF is a triple leveraged bond fund. I think there's risk in TMF mostly because when you have a company that goes an underlying like a TMF that goes up and down on a 3x basis, you really risk what we call leverage decay, and that's because you could get like TMF has had a bad week. So, say you're down 5% on the underlying, well, now you're down 15%. Well, now to recover, you have to get up like 18%. So you can kind of get stuck during volatile times in a bad position on TMF. I'm not a bit, especially it's even worse if you have options on it. I don't like TMF. I think that's too much. The leverage decay is too dangerous. Okay, I want to take a look at this Nick Tiermos piece. So let's see here. All right. Okay. Whether interest rate cuts from the Fed can engineer a soft landing depends on partly how much weakness is under the hood of the economy. So I wouldn't be surprised, first of all, that Jerome Powell probably, I mean, I can't say with certainty, but I wouldn't be surprised if you had J Powell give a little nudge to Nick T to write this. Somebody says Nick T just tweeted. Okay, let's see. All right, give me a sec. Oh, this is surprisingly annoying. I prefer the studio. This is some craziness. Nick T. Fed's preferred inflation gauge showed a gain of 2.2% in the 12 months ending August, not far from the 2% target. The measure was at 3.4 and 6.6 1 and 2 years earlier. Yeah, I mean, he just basically gave us a chart showing us how close we are on PCE. Well, but this is why we got 50 as well. 3-month annualized rate 1.5%, 6-month annualized 1.9, 12-month 2.2. So actually, if you just annualize, that's actually big. If you annualize the last 3 months of inflation, you're actually lower than the Fed's target. So that's not great, because if you look at the Fed and its restrictiveness, what you've actually done is you've seen inflation over the last year go down, 1.4% based on these annualized figures, and you've seen the Fed funds rate go down. And this is on the hold on. This is headline PCE, core PCE. Yeah, that's headline. Headline PCE is 1.5. Wow. Okay, so that means you've seen headline PCE go down closer to 2% over the last year. And yeah, because it was 3.4. Now it's 1.5 on the 3-month annualized. Okay, 1.9% decline in PCE, yet the Fed has dropped rates 50 basis points. So that means you've actually now tightened by an additional 1.4 percentage points. So that tightness is what's starting to hit the economy. That's what's starting to hit consumers today. That's not good. Hunting Crypto says, how do we sit here and believe inflation has gone down when home prices, shelter prices, insurance prices, groceries, and fuel are all killing the everyday consumer? Where's the mismatch at? Well, the mismatch is in your understanding of inflation. Fuel prices have gone straight down nearly. Grocery prices are getting slashed. I mean, look at Whole Foods or Amazon. They're talking about how much they're dropping prices, or Walmart. Insurance prices lag, and they've gone up a lot, but there's still a problem in insurance. And you're already seeing rents that have flattened out. New market rents are basically flat, and you're literally getting housing deflation in areas like Texas or Florida. So, if you actually look at the recent data, there's no inflation left in the categories you're talking about, with the exception of insurance. I agree with you. That one sucks. Yeah, it's still lagging. So, I think we have to remember that there's a little bit of an oopsie doopsie when it comes to inflation, and that inflation drives prices high, and those prices can stay high absent deflation. It just potentially means they don't keep growing. So that makes it a little challenging to understand, and a little frustrating. But I mean, pricing right now for gas is back at 2018, 2019 levels. We're not as high as we were in 2011 to 2013. We're like 2010 levels. We're lower than 2010 levels. We're at 2009 and 2018 levels in terms of gasoline prices in the United States. You can see that here. It's pretty straightforward. Hold on, let me put it up on screen. There you go. Oh, look at that. Yeah, that's where we sit on that gasoline prices. So this idea of this runaway, never-ending inflation is just, it's A, wrong, and it's just not happening right now. And B, maybe the crypto in your name is influencing you a little bit to believe that inflation must be coming in higher. And then, of course, you get people like this, Christopher Keith. What? Kevin is out of touch. No, I'm just not an idiot. Like, understand economics. You're here to, if you're here, you should be an investor and you should understand economics. What I just said is accurate. And your suggestion implies you're clueless. Discover Yourself says, good morning, Kevin. I've been watching your videos and journey from 2018. I wanted to say thank you for your honesty and courage to be a centrist and true good human being. Oh, thank you so much. I appreciate that. That's really nice. I need to get some coffee. Ooh, boy. Goldilocks. I actually don't think this data is Goldilocks when the consumer is rolling over the way it is. Yeah, it's not good. Am I an idiot for seeing the gas prices still at highs? Well, it's a chart, sir. If you actually look at the chart and you see you're back at 2018 levels or the levels that I told you, you can see they're substantially lower than all-time highs. If you think they are still high, well, yeah, I'm sure they're higher than they were when oil was negative $30. I'm sure they're higher than they were in 2017, but they're certainly a lot lower than they have been. So I don't know. Get a grip. I'm an investor, but you're bullshitting. You don't understand a chart. I just showed you a chart. Sorry, man. You lose. It's okay to lose. It's okay to be wrong. I gave you a chart. And you looked at the chart and go, well, that's still high. Okay, so you're emotional. Go have a beer. Have a beer. Maybe go on Grinder or whatever you're into, and relax a little bit. All right, let's go into this Nick T piece. So, all right, how do I do that? I want to do both. That doesn't matter. We'll just do this. All right, let's see what we got here. Okie dokie 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 dokie. Okay, so whether interest rates from the Federal Reserve can help engineer a soft landing depends partly on how much weakness is under the hood. Yeah, this is Jerome Powell's concern. Sounds like Jerome Powell's concern. Success also depends on lower borrowing costs, spurring new investment. Yeah, I don't think so. Weakness under the hood, reiterated by today's data, consumer income and spend. Lower borrowing costs. Lower borrowing costs are a bit wishful. Many yields moved up. Many yields moved up after the Fed's 50. Okay. Fed, Jay Powell last week said a half-point reduction in interest rates showed strength, affirming the central bank's desire to avoid having to make more dramatic cuts later. We don't think we're behind. Commitment not to get behind. Soft landing brings inflation down to the Fed's goal without major deterioration in the labor market. Could be tricky to achieve because it eventually requires growth and new lending to pick up. Yeah. Bank lending has slowed to a crawl. Exactly. That's not ideal. Something not usually seen outside of recessions. Right. I imagine the Fed sees this and recognizes they may need to cut substantially more. Even with somewhat lower rates, many firms and households might be reluctant to borrow because they will still face higher rates than what they currently pay on loans. Correct. Yeah. Loans locked in several years ago. Right. So that reduces new money supply. Okay. Reduces new money supply. The issue is the difference between the marginal cost of debt, which is now falling, and the average rate on the dollar, which might still rise, or the average rate on debt. Exactly. Yeah, the average rate of debt is still going up. Correct. Yes. Particularly for borrowers who locked in before the Fed hiking. Yes, exactly. It's not obvious that Fed rate cuts would have much of a smoothing effect because the average interest rate for households and businesses is going to rise after the Fed rate cut. Right. I mean, this is a very interesting point. You're basically saying, residential and consumer loans, and let's see here, all loans. These are just rates over time. Okay, yeah, got it. These are lending. Okay, percentage rates, fine. C-scalar bullish. I don't know. It depends how they adopt AI, honestly, but I don't know so much about them. C-scalar. Let me see. Cloud. So, oh yeah, I mean, you're competing with CrowdStrike here. So I would comp those two against each other. See which has lower debt, which has higher growth rates. That's what I'd be looking at. But the adoption of AI in cyber is critical. But I don't know much about that one. In the mortgage market, rates on the 30-year fixed rate loans fell to less than 6.1%, lowest level in 2 years, down from 7.2 in May. Average outstanding mortgage was just 3.9. Right, exactly. The rate has barely budged. More, the drop in rates hasn't done much for boosting housing affordability. Of course not. Fed last week trimmed its short-term benchmark rate by half. That's fine. For debts that mature, corporate borrowers with lower loans could face a sizable increase in new costs, basically. That's fine. Investors are optimistic because the Fed has plenty of room to cut. Well, yeah, but they better get to it. And this is a problem. But they better not wait long. Remember what Nick T said. Remember Nick T tweeted we were at 3.4% PCE headline 1 year ago. Now at 1.5% annualized on 3 month. That means with rates down 50 BP, we tightened by 1.9%, so 190 basis points. We loosened by 50 BP, and we're actually tighter by 140 BP compared to a year ago, except now the consumer is really beginning to indicate they're out of capital. Not great. Okay. There is a risk the current easing cycle could see similar challenges. What challenges? Subset, smaller, riskier companies with floating rate debt enjoy immediate breathing room. Yes, if you have floating rate. Lower interest rates in the U.S. might weaken the dollar, allowing emerging market economies to ease without weakening their own currencies. Yes, that's fine. Let's see here. Many households. Well, yeah, people are like, oh, the Fed raised so much and everything was fine. Well, yeah, but you had high savings and you have a lag. Many households were resilient because they locked in low borrowing costs. Rate tightening cycle ran into the fact that we had just loaded companies up with cash buffers. Exactly. Which meant you didn't need debt. And it really blunted the transmission of policy. Yeah, I actually think that's a really good way to put it. Central bankers must accept that they have very limited knowledge of how policy transmits through the broader economy. Right. This is why I've been saying 50 BP does likely nothing for us for at least 6 months. Okay, some business owners greeted last week's rate cuts warily. Even a full percentage point cut in rates isn't going to do a lot because we're still coming. Yeah, exactly. Okay. It's just a path. Everybody sees it no matter where you play it. Whose brands include Ergo Baby and the apparel maker 511. At the beginning of the year, job vacancies at his companies reflected difficulty recruiting candidates. Today, his businesses are slowing, and they're slow rolling hiring and holding off on unfilled jobs on purpose because demand has cooled. Right. Well, that's the thing, right? A year ago versus now. It's not good. Oops. Versus now. Not great. A few industries illustrate the dynamic better than real estate, moving from a period with historically low swiftly to 2-decade high. You've seen the deterioration of commercial real estate. Yeah, we already know that. Many property owners with debt that carry much lower rates are waiting until the last possible minute to refinance. Well, yeah, I mean, people who have the lower rates, but there are also plenty of people who have a lot of equity in their homes and they're willing to refinance now, or they're lowering rates from having purchased at higher rates. Because people were still buying when rates were like 7.5%, right? Loan defaults will steadily rise unless there are significant cuts in the year ahead because property owners won't be able to roll the maturing loans. Yeah, this is commercial. Basically more commercial stress. Yeah, this is a good piece by Nick T here. I find this one really good. And just that you now have Nick T talking about, I don't know, can we stick a soft landing? That's also kind of scary. Because, yeah, you kind of, that somewhat implies that the Federal Reserve is freaking out over their ability to actually stick it. That's a good piece. All right. Yeah, I do think that China may have waited for the Fed's first cut to introduce their stimulus to avoid weakening the yuan even more. So, could you please take a look at Costco? Didn't they just report earnings? I thought they did well. I don't know what they did. Let me see. Or they just reported. I don't know what they did. It was yesterday though, but I wasn't paying attention. Somebody says I bought my first house this month, 7.1%. Oof, got to refinance. Exactly. Costco comp share sales, including gas, up 5.4. Expectation was 4, so that's good. That's a beat on total comp sales. Total revenue came in at 79.7 versus an estimate of 79.96. Oh, they missed a little. Wow, you usually don't see Costco miss. Their EPS beat a bit, though. Costco sales momentum aided by strong traffic. Yeah, but your revenue missed. Huh. One of the things about Costco is that they're kind of crazy in terms of like the valuation's gone straight up. But let's actually calculate their valuation because I don't remember what their peg's sitting at now. I remember it being very high, but I don't remember exactly what it is. So I suppose I should figure that out. Okay, $901 divided by 1783, 50 PE for Costco. Oh, this isn't gonna go well. Oh no. This is gonna go very poorly. If you're investing in Costco, you are not going to want to know what the average growth rate is over the next 4 years. 45.58. That's an average growth of 11.4. Okay, and they have a PE of, what did I say? Oh, no. Okay, yeah, 53. Yeah, 50. Hold on. 901 divided by 17.83. There we go. PE is 50.5 divided by an average growth rate of 11.4. Oh, no. It has a PE ratio of 4.4. That's insane. I mean, what we really should do is like just make a list of some of these insane valuations. Insane pegs as of September 27th, 2024. Can somebody else write some insane valuations over here? 4.4 at Costco. That's freaking nuts. Palantir, I know, is another one that's like stupid. But let's do Palantir and Tesla really quick, and then I'll look for some suggestions. I didn't say PE of 4.4. I said PEG ratio. That's horrible. The PE is 50. Costco should be under a 2 peg. Okay, Palantir right now is trading at, this is going to be nuts too, 103 PE. Okay. Palantir, 103 PE. And then it is expected to grow over the next 4 years by 20.85 plus 20.05 plus 24.27 plus 23.44, 88.61 divided by 4 is 22.15% growth. 103 divided by that, 4.65. 4.65 peg on Palantir. Like, I love Palantir and I love Costco, but these valuations are stupid. I will not have a single dollar of either money I manage or my own money go into prices like that. It is irresponsible. This is stupid, is what it is. Well, but then again, markets are trying to price to perfection here. We got our soft landing has been achieved. Kevin to Houston, we have achieved a soft landing. Oh, really? Yes, we are confident of it. How confident are you? We are 88% confident we will not have a recession. Really? What does the bond market say? They're only 50% confident. Stupid. Okay, so Tesla has a PE ratio of 112. Oh my gosh, this is going to be disgusting. Oh, no. Okay, 133 divided by 4, 33.25% growth expected. But they're a manufacturer, 33.25% growth. 3.38 right now on Tesla's peg. Holy crap. Oh, I love Tesla when it had a one peg. Go back and watch the videos. All right, let's see here. Could peg ratios mean less in the future? I mean, this is like, I hate to say it, but it's sort of like that, the delusion of like, but I mean, we must keep going to all-time highs. So maybe valuations just deserve to be higher now. But I mean, everything reverts to mean over the history. So it's crazy. Like, the only good valuations I feel like left are like Enphase or Ubiquity's done excellent. So Palantir has CIA money. Yeah, I can't fit that into the peg. Wingstop. Oh, that's gonna be crazy. Yeah, let's do Wingstop really quick. Peg is price to earnings growth. So what you do, I'll show you how to calculate it really quick. Well, I'll just tell you about it while I do it. So you take a company like Wingstop. Okay. So you just write down Wing, and then you put in what the PE ratio is, which is you take this year's, well, I like to take this year's rather than trailing 12. I'm going to take the current price, 426.46, and I'm going to divide that into current year earnings, which is 377. So that means the PE ratio for Wingstop right now is 113. That's insane. And then, like, a high PE ratio can be okay if you're growing very, very rapidly. But a company that's like a service business, like a Wingstop, it should be like a 1.5 peg. So now I'm going to add together its growth for the next 4 years, which comes out to 87.4%, divided by 4 to get a growth rate per year, 21.85. So now I take a 21.85% growth rate of earnings, and I take the 113 PE and I divide the 113 by the 21.85. I get Wingstop literally sitting at a 5.1 peg, 5.17 peg. That's insane. NVIDIA is not bad. NVIDIA, I think, is like under 2. NVIDIA is pretty good, but it depends on NVIDIA's growth, which is hard to predict. Somebody says, Kevin, check Nick T. We already went through his tweets and his latest article, unless he has more. Oh, here we go. The Bureau of Equalization. Okay, let me see what he has. Oh, shit. How did they do this? Given that the personal savings rate has now been revised up? How do you figure these revisions? That's crazy. Because the numbers came in weak today. That's interesting. Bureau of Economic Analysis revisions to income figures. That's a big gap between before revision and after revision. So this is the personal savings rate from July has been revised up. How do they do this with the revisions? Constant revisions have been, huh? All right, let me keep looking at some of these data points. Let's look at Microsoft. So, or even like Apple, right? So Microsoft, which I really like. Oh, and then Walmart, that's a good one too. Microsoft, let's try them. MSFT. Microsoft should be okay. Should be, but I can't remember. They're trading for 432, 5 divided by 1320. Trading for 32 times PE. And then the growth rate for the next 4 years, based on sort of the Wall Street consensus estimate out there, 15.96, 18.56, 11.52, 12.87, 58.91 divided by 4, 14.72. That's actually pretty good. You're just barely a 2-peg. Yeah, 2.17. That's actually totally fair for them. That's a fair price. Okay, very interesting. Walmart should be high. Oh, Walmart. Let's take a look at Walmart. 14 minutes to go until the bell. 14 minutes remain. Okay, so if I look at Walmart, Walmart's trading at about 79.92 divided by 245 puts me at a 32.6 PE, which is the same basically as Microsoft. A little bit of a lower growth rate though. 10.76 plus 12. And we should talk about what makes this go wrong in just a second. 43.55. So divided by 4, they've got about a 10.8% growth rate. 32.6 divided by 10.8. Yeah, that puts them at about a 3-peg. So a little high on Walmart, especially since they're not like a SaaS biz like Microsoft. Microsoft's actually probably a good deal right now. But anyway, there are some problems with this. If a company has growth that hits a wall, like, I don't know, Enphase doesn't end up growing the way people think it will. What ends up happening is the PEG ratio makes the company look cheap now, but then it ends up being really expensive in the future. So that the change in the growth rate is really, really important. So you have to kind of watch what the company is doing and how things are changing. Another example could be the PEG ratio could be very, very low. The PEG ratio could look very, very high, and the growth estimates could be very low. Growth estimates get revised up. And if you're not paying attention to that transition in the company, then you could think something is overvalued when it's not. So you kind of have to look at a moment in time on PEG and then look at what you think for future growth. And then compare to what's actually happening in the earnings calls and earnings reports and all that. Yeah. So that already came out today. Do you think the super micro dip is exaggerated? I think super micro is a bad company. I don't like super. I didn't like super micro at $900. I didn't like them at $600. I remember saying it at $600 too. I'm like, they're giving away their server racks just to try to get market share. Their AI margins are horrible in the low single digits. Their regular server racks are like 10 or 11% margin, which is a very low margin business, very at risk of disruption from competitors. I hate the business. I don't even care that they are getting investigated because it's just not a business I touch. Do not care. Do you think there might be more downside for Bitcoin at some point? Well, if you have a recession, it's gonna be terrible. It says free cash flow could be better. Yeah, I don't know about that because you have to be careful. An example would be like a company like NVIDIA has substantial free cash flow right now. But one of the issues you face is that we expect at some point their chip prices will normalize. And when their chip prices normalize, their cash flow is going to substantially collapse. So free cash flow can come and go. You generally, stock markets prefer businesses that can prove earnings growth. So yeah. What's the valuation for Supermicro? I don't know. Let's go look. Depends again what their growth projection is. All right. So, oh yeah. Well, that's interesting. 2 years of growth ahead and then 2 years of negative growth. Okay, so this is going to take a little bit of work. So 402.4 divided by 33.74, trading for about 11.92. 92 on the PE. But their growth rate, this is going to be an interesting one to work out. 34.31 plus 31.67 minus 31.3 minus 9.86. 24.82 divided by 4. 6.2% growth rate. So 11.92 divided by 6.82. It puts you at about a 1.74 peg. So it's not bad. I just think, like, even though it's probably closer to a fair valuation, it's still a trash company. My take. Matt says, see, Matt's got $1 million and doesn't want to spend a little bit of money to get an actual financial advisor. I think that's a mistake, man. Like, you got $1 million sitting in your Vanguard money market, and now your money market drops, rates are dropping. Should I just say screw it and throw it in the market? This depends. How much real estate do you own? How much other net worth do you have? What's your income? What's your age? If you're, can you actually earn an income? Do you have any business ideas you want to use the money for? It makes it impossible. But I mean, just from the market POV, I know there's so much FOMO when the market goes up, but that's what makes the market keep going up to ridiculous valuations. That's actually why we're looking at these valuations now. Costco peg of 4, Palantir 4.65, Tesla 3.38, Wingstop 5.17. These are some crazy valuations. I think buying at some of these levels would be would just frankly be a disservice to oneself. Especially potentially in the face of the R word. So, House of Cards says, dude, go see a financial advisor. I just did, and there were a lot of changes I need to make. I totally agree. Yeah, I think House of Cards actually giving good advice here. Big fan of that. So I would encourage exactly that. I like. Obviously, I mean, my team's doing financial advice now starting October 1st. We're excited about that over at StockHack. Because as a financial advisor myself, be able to look at your situation and go, okay, how can we actually help you make the right decision for you? Your situation could be very different from, well, certainly my situation or somebody else's situation. Everybody's going to be very, very different. So there's a reason why people say, oh, not financial advice on the internet. They should actually be saying not personalized financial advice, because you're allowed to give financial advice on the internet. People don't have to listen to you, but you can't give paid personal advice unless you're actually an advisor, because that now gives you a fiduciary responsibility to go through, someone's situation and actually provide real value. So big fan of that. Anyway, that's stockhack.com. StockHack. I should put like a little banner up or something like that. Yeah, that's what we'll do. Put a little banner up like this. Look at that. All right. Somebody here says, I missed the 2019-2020 buy the dip, Kevin. Where were you, like, November of 22 to July of this year? It is like, what is that? 11 minus 7. A lot of months. I don't know. I'll go going the wrong way here. That's like 8 months or whatever of buy the dip. And all of a sudden it's like 2 months of, I don't know, man, this doesn't look good. And you're like, I miss the old Kevin. Oh my gosh. Do you want me to be a numbnut that sits here and doesn't actually provide you what's happening in markets? Do you want me to say, all right, guys, today, no matter what the data is, we're just gonna buy? I don't know, man. Maybe you gotta find somebody else if that's what you're looking for. That ain't me. That's stupid. What do they say? That's ignorant. All right. So all right. Let's see here. Let's see. We got 3 minutes to go until the opening. Can I get Symbiosis up? I think I can. Because we got to get the bell. Doobity-ba-ba-da-boo. All right. Yeah, I think I can get Symbiosis here. CNBC's on a commercial break. Bro, that's a scam. That's a scam. You know, these days, that's like a compliment. Because apparently every successful business is a scam these days, according to the internet. Oh my gosh, you're a capitalist. That's a scam. Okay. So, hope you all have a nice weekend, by the way. I got to go hit the airport after this. I'm going to hit the bell. I go to the airport. Ugh. All right. Let's see here. 2 minutes remain. And then I gotta get some coffee. This is crazy. Turning OpenAI into a real business is tearing it apart. Oh, yeah. Well, it's interesting how you could switch from non-profit to a profit. I'm still a little confused by that. So... what else? Amazon spared UK antitrust probe. Boring. Why is silver having a golden moment? Boring. Let's see how things are moving this morning. Let's take a quick little look. So we've got bonds that down 2 basis points on the 10. And yeah, well, because the inflation data is fine. The 2-year is down 1.9. Oh, that's some more inversion. Interesting. Inversion. And then you have, how's oil doing this morning? Oil also down again. All right. Well, let's see if we can resume some of the rally. That would be entertaining. All right. Present the screen. Share the screen. Share the tab. Pop-up-paya. All right. See if I can get this to work. So they'll be back in a moment. We'll get the bell together. Oh, here we go.
Keeping an eye on WTI. You can see well below 70. Obviously, it was down yesterday on these reports about the Saudis abandoning the sort of $100 a barrel target, Mike.
Does that echo when you hear it like that?
Despite
it might echo.
what may be an uptick in demand from China if they actually do get things going there.
Yeah, it's been the exception to the usual China reflation playbook, which really was executed yesterday. You're seeing metals move. You're seeing a lot of the other commodity-related stuff move.
Yeah, that CNBC is a little more delayed than usual. We'll get because the bell is supposed to be like right now, so you get the Kevin bell. Ding 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 ding.
You have a lot of confidence in soft landing. Yields are tame, and gasoline staying out of the way.
One of the two sectors lower on the week, down 3%.
All right. There she blows. Look how green that is. That is pretty dang green if I've ever seen pretty dang green.
Technologies also celebrating a recent IPO. So I talk about the fact that there aren't that many IPOs. Well, there are some. They may not get quite as
All
high
right.
profile as the
Well,
ones that we
good
might
luck.
be
Good
awaiting
luck,
at some
everyone,
point
on
down
this
the
trade
road if
sale.
they
Let's go
ever
see
come.
I mean, when
what
you're
L Market
really
is doing.
in
So
a sweet spot for deals, you kind
here,
of can't keep up with the
stand
IPOs.
by.
Literally,
We will
some fall
jump
by the wayside.
over
You have
in just a
multiple.
moment. Let us remove this button. And now I will press this button, this button, this button, this button, this button. Oh, that takes forever. Man, I need to be in the office. The studio is a lot easier. All right, what we got? Looks like Tesla's popping up, going to 158 here. It's a pretty nice move right there. Will it last? Then you've got, what else do we have here? IWM. That's pretty bullish. Redfin's got a little bit of a pop. The Qs are actually going down. What's dragging the Qs down? NVIDIA. NVIDIA is dragging the Qs down. Rocket Mortgage is up, Loan Depot's up, United Wholesale Mortgage is up, Apple's up, Microsoft going down, SPY going down, Disney's up a little bit, Palantir's going down a little bit, Rivian, Ethereum. Ooh, look at that Tesla rocket ship. It is now past the 258 line. Will it hold? IWM and ooh, the Q is now fully red. Ooh, very interesting. What is happening in the stock market right now? Okay. Redfin's also popping down a little bit. Okay, here come the Qs back though. You really need the Qs to stabilize to not have continued problems here. I feel like with some of these other plays, but let's watch. So, yeah, come on Tesla, you can do it. Yeah, there you go. Q's stabilizing a little. That's good. Bitcoin, Bitcoin's just doing the bad omen. You know, you had a nice little run there, but you're just getting the omen. Come on, Microsoft trying to bounce now. Apple's trying to bounce. Nvidia's, look at that, right on my 123 line. Trying. What's the end phase doing? Yeah, pretty bullish. Pretty green day. Oh, Palantir just went green. Lululemon's green. Solar Edge is actually quite green today. Well, that should help end phase. How is end phase doing? 113 line, or where we at? Okay, popping up a little bit. It's like a bullish day. And yep, here come the Qs back a little. Nice. Somebody says Rocket Lab Mooning. Oh yeah, look at that. 5%ies. Percent of dudes. Interesting. Oh yeah, no, Tesla's having trouble breaking out here. Redfin also having trouble. Here's a 20-year bond of 0.5%. BTC. All right. Seems pretty straightforward. I mean, maybe not. Market seems to be a little. And is it going to go up or down today? You know, a firm. Even a firm doesn't want to figure it out. Coke wants to go up, but then again, who doesn't want Coke to go up? Rocket Lab. Here you go. Q's climbing again. Well, this is good. If you get the Qs to go up, you can sustain some of the other rallies you're seeing in some of the other stocks. So, oh yeah, Michigan sentiment comes out in a bit. That's true. Somebody asked, anything changed on Tesla for you? Buy the rumor, sell the news on which I say, oh yeah, no, nothing's really changed for me there. Not a great fan. I mean, I hope they do fine. I really do. I think they're great people at Tesla, and I'm a big fan of what the company is trying to accomplish. I really am. But yeah, I do have substantial nervousness over uh, how much their valuation has moved to a three peg right now, and then also what we've seen with consumer trends. Because now, unfortunately, the people who are getting hit are the white collar buyers. This was different in 2022. 2022, we weren't really nervous about the white collar buyer getting hit. Today, we are. Oh, yeah. All right. So what else here? The Qs just went negative. Now, that's really interesting. Uh, Tesla's still playing between the 258 and 260 line here, but the Qs just lost the lead a lot. Look at that. Down. Now you're down negative 3 basis points. That's crazy. And then what else? Tesla's like barely holding on here. Uh, okay. Yeah. Now it's all going down. I think that it could be because of nervousness over the sentiment data coming out. It's possible, or it could just be sort of your normal kind of morning market fluctuation on this. Um, it's hard to say. Somebody says Nvidia is selling off. Is that true? Let's see here. Yeah, I mean it had its candle down, but it's trying to come back up over here. So okay, I think now, fortunately, I probably got to go. So remember, as I always say though, not financial advice. Always try to do your best out there. Good luck. Good luck on your moves. Whatever you got going on, I love you all. Yeah, look at that. Nvidia is just really struggling to keep it up today. And if you want some financial advice, actual financial advice, make sure to go to stockhack.com. Service starts October 1st. All right, folks, I got to go. We'll see you soon. I got to get to the airport. So we'll do probably some, of course, catch up. All right, thanks, folks.